Hi everybody, it's Peter Schiff, and it is Thursday, July 15, 2010. Well, a few days ago when I last recorded my video blog, I mentioned that I thought the US dollar was looking weak. The dollar index was trading at 84, and I thought it looked like it would crack 83, and today it did just that. The dollar index was down more than 1 full point. We closed below 82.40. The dollar was weak across the board, particularly against the euro, where the euro is now back above 129, but it was very weak against the Japanese yen. Even a currency like the New Zealand dollar made a new 52-week high today against the US dollar. Now, the dollar index is now dropped, I guess, what was it, maybe 9% from its peak about a month ago. It's fallen, I think, for 4 consecutive weeks. This might be the 5th consecutive week. I'm not positive there. But, just the top of the dollar seems to have coincided with the divergence that we had at the G20 between Europe that wanted austerity and real budget cuts and America that wanted more government stimulus and more deficits. Well, it seems like people are voting with their feet, and they're voting for the European approach and against the U.S. approach, and that's why the dollar is so weak. When I first wrote Crash Proof 2.0, or Crash Proof, the original book, and I predicted, all the problems that we have in the economy, one of the things that I also said would happen was that the dollar would fall. And of course, when the crisis first began, we actually had a big rise in the dollar. And I got a lot of flack for that in the media because people tried to discredit me by saying, oh, look, see, Peter Schiff was wrong. He said the dollar was going to fall, but it rose, so he's wrong. Now, of course, look at all the things that happened. Most economists or most traders, if they believed, like I did, or if I told somebody in 2007 that this is what's going to happen in 2008, the housing market's going to implode. Right? Real estate prices are going to drop 30% nationwide, 50% in places like California, Las Vegas, Florida. We're going to have major bankruptcies of large financial institutions like Lehman Brothers, Bear Stearns, Merrill Lynch, Washington Mutual, Fannie and Freddie. They're going to go bankrupt. Chrysler, General Motors, bankrupt. The government's going to bail them out. AIG is going to go bankrupt. That we're going to have the worst recession since the Great Depression. That we're going to have double-digit unemployment. That we're going to have an explosion in government spending. We're going to have trillion-dollar-plus deficits as far as the eye can see, that the Federal Reserve was going to slash interest rates to 0. If I told you all that was going to happen, and of course I did, but let's say if somebody knew for a fact that all of those things were going to happen, and then they were asked one question, or they could make one bet on the direction of the dollar, would you expect that with all these things happening, that the dollar would go up or that the dollar would go down? I don't think anybody, maybe 1 out of 100, would say the dollar will go up in that environment, right? Worst recession since the Great Depression, 0% interest rates, trillion-dollar deficits, pedal to the metal on the monetary presses. I can't imagine, right? So are people really thinking that it was so crazy for me, given what I knew, to think the dollar was going to fall? Now, you know what? It's still going to fall. I'm convinced it's going to fall. It's just that it had a rally first. We had a head fake. And about a month ago, we had positive dollar sentiment that has been as high as it's been in years. And the sentiment was very, very negative on the euro. Everybody was talking about the collapse of the euro. The eurozone is going to fall apart. The euro is going to go back to par with the dollar. So we set the stage sentiment-wise for a big dollar decline. And I think it's going to happen. I mean, I wasn't wrong in thinking that the financial crisis would kill the dollar. I might not have anticipated that before it died, it would have one last gasp for breath like we did in 2008. And that's what's happening. And, I was watching on CNBC today, and one of the economists there, Steve Leisman, who Steve and I used to argue quite a bit years ago when I was predicting the economic crisis, and he was kind of making fun of me. But one of the things that Steve used to always say to me was, well, Peter, you've been saying this for years, and the economy's in great shape, so you're wrong. Well, what Steve didn't understand is it wasn't in great shape. I was warning about the problems in advance because I understood them. He didn't. See, he saw all the GDP growth and thought it was real. I knew it was an illusion. I knew it was financed by debt. I understood that rising real estate prices were going to collapse, that the stock market was going to come down, that phony wealth was going to disappear, and we were going to be stuck with the bill. Well, he's making the same mistake now. I heard him on CNBC today saying that there's no inflation, and the people who have been forecasting inflation said that they said we'd have inflation as a result of the expansion of the Fed balance sheet, of all these bailouts and money printing. He's saying that those people were wrong. Well, I mean, I thought he was talking specifically to me, but of course, we're not wrong. There is inflation. It's right here. Yes, the results of inflation, as far as what Leisman and other people are looking for, they're looking for the CPI. They're looking to see prices going up. I mean, that's kind of like standing on a train track, and there's a locomotive coming at you, but you don't want to move out of the way until you see the caboose. Well, by the time the caboose is there, it's certainly too late to step away from the train. In the inflation train, the money supply is the engine. Consumer prices are the caboose. We know we have inflation. It will show up in consumer prices. In fact, it's already showing up. That's why they're not falling. Consumer prices should be dropping. Real estate prices, stock should be dropping. They're too high. They're not because the Fed is creating inflation. But at some point, the inflation is not just going to hold prices up. It's going to force them through the roof. But by then, of course, as I said, it is going to be much too late for the Federal Reserve to do anything about it. And of course, if they try to fight the inflation with much higher interest rates, well, now they do more damage than had they fought it initially, because now we're deeper in debt. Now we're even more vulnerable to a rise in interest rates. It's like we were drunk on alcohol, we got the hangover, and then we took more alcohol because we didn't like the way the hangover felt, but now we got more alcohol in our system, and now it's going to be even worse when we got to go cold turkey. And then the risk is that it's so bad that we don't do it, that we don't go cold turkey, that we just print and print and print, that we never that we never stop drinking, and we drink ourselves, we die of alcohol poisoning. And that's going to be runaway inflation. But also I want to talk about, not only was the dollar weak today, but even when the Dow was down about 100 points, I think it finished, positive slightly, but even when the Dow was down, the dollar was still way down. That correlation is breaking, that the dollar is falling whether stocks rise or fall. And to me, it shows that this really could be, and I've been talking about this now for the last month, that the bear market rally in the dollar is over. And if we're in the next leg down, now I know for a while people are going to be complacent, and there's still a lot of positive dollar sentiment. So the dollar is going to fall this slope of hope as people still think it's going to rise and think things are worse in Europe. But once we get now below 80 and get closer to the lows or maybe break them, then people are going to start to worry about the weak dollar, and it's going to start to be a problem for the bond market. And when it's a problem for the bond market, it's a big problem for our phony economy. So continue to watch this divergence, and the next divergence that will come will be when stocks and bonds move down together. I mean, we still had a rally in bonds today. So even though the dollar was weak, bonds still went up. But of course, if people are losing confidence in the dollar, why would they want Treasury bonds? After all, if you don't like the dollar, you certainly don't like the dollar 30 years from now, because that's what a Treasury bond is, a promise to give you dollars in 30 years. Well, if the dollar's going down now, why would you want to hold it for 30 more years of decline? So if you don't like the dollar, you got to hate Treasuries. And eventually that's going to happen. And that will really expose the flaw in our phony economy. And thinking about phony, today the Senate finally passed financial reform. And I've spoken on this blog before, but this is just Washington theatrics. This is so senators can go home to their district and pretend that the fat cats are going to pay now on Wall Street. Well, they're about to get a lot fatter feeding off this bill. What it's going to do is the too big to fail firms are going to get even bigger, because now it's going to be easier for them to attract capital. Smaller firms are going to have a more difficult time not only attracting capital, but keeping their capital, because the regulations that are going to follow this bill, and they're going to be numerous, they're going to be very expensive for the smaller firms to absorb the costs. Many of them will fail. Many of them will merge with the bigger firms. I have no idea how bad it's going to impact me at Euro Pacific Capital, but believe me, every time one of these huge firms with the government help rips off their customers, does something wrong, sure, they take a slap on the wrist. Goldman Sachs, they paid a $500 million fine today to settle these charges. But you know what? That's peanuts compared to the money they made off of government stimulus, off of cheap money from the Federal Reserve, off of the Greenspan put. But, firms like mine that never take a dime in bailout money, that can't borrow from the Federal Reserve, I'm going to have to pay for the cost of their mistakes. Anyway, that's it for today. I'll be back again soon. Take care, everybody.